Subscribe to our channel, press the bell icon and never miss an update from Latestly.
The MPC reviewed the domestic and global developments and their implications for the outlook. After extensive discussions, the MPC voted unanimously for a reduction in policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth and to mitigate the impact of COVID-19 while ensuring that inflation remains within the target. On the quantum of reduction, the MPC voted with a 5:1 majority to reduce the policy repo rate by 40 basis points, 40 basis points from 4.4% to 4%. Consequently, the MSF rate and the bank rate now stand reduced to 4.25% and reverse repo rate stands reduced to 3.35%. By all counts, the macroeconomic and financial conditions are austere. The global economy is inexorably headed into recession. The global manufacturing PMI contracted to an 11-year low in April 2020. The global services PMI recorded its steepest decline in the history of the index. Among advanced economies that have released GDP readings for Q1 of 2020, contractions were in the range of 3.4% to 14.2%. For emerging market economies, the growth rate ranged between 2.9% and minus 6.8%. EMEs face additional pressures in the form of capital outflows and asset price volatility from the bouts of turbulence afflicting financial markets. The plunge in crude prices has dried up budgetary revenues for oil exporters. On the other hand, oil importers have been denied terms of trade gains by the crushing blow to demand delivered by the pandemic. According to the UNCTAD, the value of global trade contracted by 3% in Q1. The volume of world trade can shrink by 13 to 32% in the current year as projected by the WTO. Global financial markets have calmed after a turbulent period in March and volatility has ebbed, but markets have generally been disconnected from the developments in the real economy. Relatively unsung, global policy response by central banks and governments has been unprecedented. The combined impact of demand compression and supply disruption will depress economic activity in the first half of the year. Assuming that economic activity gets restored in a phased manner, especially in the second half of this year, and taking into consideration favorable base effects, it is expected that the combination of fiscal, monetary and administrative measures being currently undertaken both by the government and the RBI would create conditions for a gradual revival in activity in the second half of 2021. Nonetheless, downside risks to this assessment are significant and contingent upon the containment of the pandemic and quick phasing out of social distancing and lockdowns. Given all these uncertainties, GDP growth in 2021 is estimated to remain in the negative territory, with some pickup in growth impulses in H2 2021 onwards. The end May 2020 release of NSO on national income should provide greater clarity. Against this backdrop, the MPC assessed that inflation outlook is highly uncertain. The supply shock to food prices in April may show persistence over the next few months, depending upon the state of lockdown and the time taken to restore the supply chains after relaxation of the lockdown. Among the pressure points, the elevated level of pulses inflation is worrisome and warrants timely and swift supply-side interventions, including a reappraisal of the import duties. Immediate step-up of open market sales, PDS offtake by FCI to offload some part of excess stocks can also cool down cereal prices and also create room for Rabi procurement. Given the current global demand-supply balance, international crude oil prices, metals and industrial raw materials are likely to remain soft. This would ease input costs for domestic firms. Deficient demand may hold down pressure on core inflation, although persisting supply dislocations impart uncertainty to their near-term outlook. Much will depend on the shape of the recovery after COVID-19. Accordingly, the MPC is of the view that headline inflation may remain firm in the first half of 2020, but should ease in the second half, aided also by favorable base effects. By Q3 and Q4 of the current financial year, it is expected that the headline inflation will fall below the target of 4%. Thus, the MPC's forward guidance on inflation is directional rather than in terms of levels. The RBI had earlier on two separate occasions, on March 27th and on April 17th, when I made statements in the media. The RBI had announced, on both these occasions, certain regulatory measures pertaining to granting of 3 months moratorium on term loan installments. That is the first one we had announced. 2, deferment of interest for 3 months on working capital facilities. 3, easing of working capital financing requirements by reducing margins or reassessment of working capital cycle. 3, exemption from being classified as defaulter in supervisory reporting and reporting to credit information companies. 5, I think 1, 2, 3, 4, 5, I'm just listing out. It's possible that it missed to, that exemption probably was number 5, exemption from being classified as defaulter. I think that was 4. The 5th point is extension of resolution timelines for stressed assets. And the 6th point was asset classification standstill by excluding the moratorium period of 3 months. So all these measures we have announced on 27th of March and on April 17th, essentially arising from this 3 months time we gave 3 months moratorium we allowed on the term loans, then on working capital we allowed certain relaxations and associated measures. In view of the extension of the lockdown and continuing disruptions on account of COVID-19, the above measures are being further extended by another 3 months from 1st June till 31st August, taking the total period of applicability of the measures to 6 months, that is from 1st March to 31st August 2020. The lending institutions are being permitted to restore the margins. Now, this is another announcement which I would like to draw your attention to. The lending institutions are being permitted, not only with regard to working capital, we are extending the time limit by another 3 months, but the lending institutions are being permitted to restore the margins for working capital to their original levels by 31st March 2020. This is one area where we had given 3 months time. Now we are now giving time that the margins which the reduced margins, that will be restored by 31st March, which will make it easier for borrowers to sort of manage their finances, manage their cash flow in a gradual manner. Similarly, the measures pertaining to reassessment of working capital cycle are being extended up to 31st March 2021.